Hi, I'm Kathy. Welcome to my video on practical and effective tips for how you can decide on how much risk you're willing to take with your financial investments. Please stick around to the end to see if you can answer 3 questions on these differing risk levels. Investing wisely involves navigating various levels of risk, with each decision impacting potential returns and stability. For beginners, understanding how to approach investments through a risk-averse lens is crucial for building a safe financial future. By focusing on strategies like diversification and clear goal setting, new investors can mitigate risks while aiming for steady growth and financial security. You'll need to begin by understanding the different types of investments and their associated risks. Low-risk investments like government bonds or diversified index funds offer a more stable return, but typically low potential gains. High-risk investments such as individual stocks or speculative ventures can yield higher returns with a greater volatility and potential losses. Risk levels are often categorized in 5 different areas. Conservative, which might include government bonds, money market accounts, CDs, and cash. There is moderately conservative and moderately aggressive, which includes real estate, mutual funds, large and small caps, as well as high income bonds. Aggressive and very aggressive. And that includes options, futures, and collectibles. The University of Missouri has a fairly quick test to help you determine how risk-averse you are. None of your personal data is collected, just the answers to the questions that they have. Once you understand what your risk tolerance is, you can purchase those assets that will make you most comfortable in investing. I'll have the link down in the comments below for you to be able to check that out. Then you need to define your financial objectives and your time horizon. How soon do you need the money? Is it for a big purchase, or college, or retirement? For risk-averse investors, prioritizing capital preservation, and this is when you're opting for a safe asset such as treasury bills and CDs or certificate of deposits, with steady growth versus aggressive wealth accumulation. You need to align your investments with goals like retirement savings or education funds, and focus on assets that match your risk tolerance and time frame. No matter your risk level, you should consider spreading at least some of your investments across different asset classes and industries to reduce your risk. Asset classes are categories of investments that exhibit similar characteristics and behave similarly in the marketplace. The main asset classes include equities, which are stocks, with shares of ownership in a company that can provide dividends and capital gains for you. Fixed income is bonds and are debt securities that are issued by governments or corporations that pay regular interest and return on the principal at maturity. Cash and cash equivalents are highly liquid assets such as savings accounts, money markets, and treasury bills. Real estate includes property investments that can generate rental income and appreciate in value. And commodities are physical assets like gold, oil, agricultural, or those kinds of things that could act against a hedge against inflation. Finally, alternative investments like hedge funds, private equity, or collectibles that do not fall in the traditional categories and often provide diversification benefits. You need to diversify because it helps cushion your portfolio against downturns in specific sectors or markets. Consider allocating a portion of your portfolio to stable assets like bonds or dividend-paying stocks, and balance that against higher risk investments that you might be making. No matter what your risk level acceptance is, you should be regularly reviewing your portfolio performance and make adjustments as needed. This rebalancing, it's the act of adjusting a portfolio to make sure that the original asset allocation, the way you purchased it originally, is still in place, should be done pretty regularly. By periodically rebalancing it, you're ensuring that you align your assets with your risk tolerance and your financial goals. You can think of it as risk versus reward. The higher the risk, the higher the possible reward. The lower the risk, the slower your balance will grow. Neither's correct. Whatever makes you most comfortable is the best investment strategy. Stay informed about market conditions and economic trends that could impact your investments, and that will allow you to make informed decisions to protect your capital over the long term. In conclusion, embracing a risk-averse approach to investing empowers beginners to make informed decisions that might align with their financial goals and your comfort levels. By prioritizing stability and prudent risk management, investors can build a resilient portfolio capable of weathering the market fluctuations over time. Can you answer these 3 questions? Why doesn't everyone just invest in the least risky option like government bonds or CDs? Which assets are considered most risky? And then why would the average person be willing to invest in aggressive stocks? I'm Kathy, and I'm grateful to be a part of your journey to financial empowerment. Please let me know what topics you'd like covered here in the comments. If you're new, please subscribe so that you too can improve the way that you think about your relationship with money.